What's up? What's up, people? How's everybody doing? Welcome to the Hidden Edge Pod. It is episode 38. I can't believe we're in episode 38, and that's actually not including those other installments that we've done. But yeah, I mean, we're sitting over here. The Qs are pretty much at all-time closing high, just a point away from the actual intraday all-time highs. And S&P 500, I think, is about 1% away from the all-time highs. And I don't know, man. It's been a wild last few months where everyone thought the world was going to end. Well, not literally, but everyone thought that we were going to be in this crazy bear market for a long period of time. It was going to be an L-shaped recovery. Here we are today at all-time highs, not like 2 months later. It's still to this day, I'm just like, wow, the sentiment just has completely flipped. And still, there are people who are bearish on the market. I mean, you need the people to be bearish on the market as a whole, because without that, there's going to be no one to buy the rip, right? So, I mean, we had a few things happen today in the last couple of days, actually. I don't think I really need to dig too much into the Middle Eastern event that has been unraveling. I don't want to say anything, but kind of knew that we were going to hit all-time highs after we got all that crazy escalation news about the bombing and everything. Mostly because of the short covering rally in oil. And then as soon as futures open, it just completely dumped. Oil pretty much drew down a lot, right? It's kind of telling at that point that we were basically going to shrug this all off when we just saw the biggest escalation in the entire event. And it doesn't look like it's going to escalate anymore, because honestly, oil is just selling off. And that would basically be it, in my opinion, when it comes to oil. I was able to catch an oil short for a little bit. Should have held on to those USO puts, because today they would have seriously printed. But I mean, hey, it is what it is. But I know you're pretty happy with the oil falling, especially with the cruise lines reporting this morning with CCL. But before we get into that, I mean, let's just jump into some macro here. I mean, Trump is swearing on air. He's pissed off about the not ceasefiring. And the big beautiful bill is going to be passing. What is it, this weekend? I don't know,
I think
man.
they're working on it. I think July 4th is when they were trying to get it.
They're working on adding more money to the big beautiful bill, making the big beautiful bill more big and probably more beautiful in a lot of people's eyes, because you're just basically adding more money to it. I think they added $1 trillion onto it after all the revisions.
I don't think that's the case. They're trying to get some of it out so that this way, long term, they could get the most conservative parts of the Republican Party to vote on it, because that's the thing. The holdouts are basically the fiscal hawks, and so you really need to get them on board. So I think, like I said, I think we'll see some revisions. I'm most concerned about student loan forgiveness. My wife has been working for the last 10 years, and this is her last year for student loans. So basically, President Bush in 2007 passed a bill where they set up something called the PSLF, so Public Student Loan Forgiveness. So if you work for either the government or nonprofit for 10 years and you make all your payments, they would basically forgive your student loans. My wife has over $200,000 in student loans. Perfect. And she's about to basically be done paying for them. Because PSLF, once it kicks in, it's supposed to, forgive that 200,000. Now, the funny thing is, if it was just 3 or 4 months before, we wouldn't even have to pay any taxes on it. But because the way that the bill is structured, in 2025 is when it ends, this one exemption, this tax exemption. So whatever the balance is that's forgiven goes into your income. So basically it counts as income. So my wife, even though her $200,000 in loans is going to be forgiven, we're going to end up paying the taxes on it. And with our tax bracket, the way it is, we're going to pay probably $50,000, so I did the math in my head, and it's my wife is
we all did the math of what your tax bracket is. We all know how much you guys are making now. We know now.
My wife is it just sucks, because My wife has basically paid for the last 10 years, and she's probably paid because like it was income driven and income repayment plan. We probably paid between $70,000 and $100,000. So if you take 70,000 plus, let's say 80,000, and then add another like 40,000, 50,000, whatever we have to pay in taxes, she took on 160,000 or 170,000 in student loans when she was still in school. So all the principal and interest and everything got added in together. And so now she's, it's like what really got forgiven? Like 30, 40,000, because most of the money came back anyway to the federal government, but it's just at a different pace.
Yeah.
So,
well, I mean, you wouldn't have been as screwed over as I was, because my dumb refinanced my student loans to take advantage of a $200 reward. Okay, so you remember when SoFi first started giving like a $200 bonus for student loans, like when they first started? This was like right before COVID, right?
Yeah.
So I decided, oh, hey, let me take advantage of this and refinance my federal loans into private loans, right? Because technically speaking, they were, most of it was unsubsidized, so I would have to pay the interest off myself. But I mean, it didn't even matter because I already graduated. But I did that, so my federal loans became private loans, and that was like right before Biden announced that they're going to subsidize the interest on student loans. On federal loans during that. And I was like, dude, I literally like I traded $200. There's no way I would have known, but I traded $200 instead of getting like 6 or 7 grand of non-interest.
Do you still have student loans?
The interest rate is so low that it makes much more sense for me to put it toward higher interest stuff. At the same time, I'm not in a rush because it really is not a lot of money. Like we're talking about like 10 grand or something. Like I could easily just pay it off, but it just makes no sense for me to pay it off when it's like 4%. Like there's no sense for me to pay it off. So I could have, and in April I actually just threw that money at the stock market instead. So I'm paying it off a bit more aggressively now that the stock market's back at all-time highs. But at the same time, it's student loan debt. Like it's not necessarily bad debt to have. Especially since it's such a small amount, and I could easily just pay it off if I feel like it. But at the same time, I think the part where you got to kind of worry about student loans is when you can't even afford the interest payment on it. That's when you kind of got to worry about it. You definitely want to make at least, and this is the financial advice, but I definitely want to make at least the interest payments on it, so that way I'm able to write it off at the end of the year. But at the same time, like, what's the point in paying this off? Like there's no reason why. I could just write off the interest every single year and so on. It doesn't matter. It's not that much money anyway. What sucks is people who want to buy a house, right? And I know you're in the market for a house as well. I mean, there are houses down my street that are listed for a lot more than the comps that are listed for a lot more than I bought this house for. So that's good to have that appreciation. But it's like, who in the world is going to buy a home for 1.2 million? What in this area? Like this is not an area I would pay that much money to live, to be completely honest. But at the same time, it's like, it's crazy how much 7% interest is on that. And even if you had just like, obviously you're not going to get a 3% interest loan anymore or mortgage anymore, but you're literally paying like 2.5 grand more just because of that interest. Like, I don't know how long this is going to sustain. Like the wealth inequality is just getting absurd at this point. And I hate to jump into it, but people are like, oh, how is this person in New York City getting elected as mayor, whatever. And like, I honestly, it is what it is. Politics is politics. I'm not going to get into like the decision-making or what my beliefs in who should be elected, who should not be elected. I'm not even in New York anyway, so I don't really care. But it's like, if people are so surprised, it's like, well, look at New York and look at the massive income inequality in that state alone. And it's a blue state. Of course, they don't want whoever has been in office, or they don't want whoever they don't want Cuomo, right? Like, because they don't like what happened. They don't like what's been happening, right? Like, I just think this is all like kind of a product of that whole situation happening. in my opinion, I think it's going to get worse. I don't think that this is the last time we're going to see like a surprising election unfold where you have a candidate who like no one would ever thought would get elected. Like this isn't like Donald Trump in like 2016. Like this is someone who literally like no one thought this person would get elected. But when things get so bad and when you piss off like one side of the majority in this sense, because these are popular votes, right? This isn't like voting for presidents, right? This is a popular vote. Like you're going to piss off a lot of people, and then you're going to get the person that that probably is not going to be the best for the state or New York City. And that's just what happens. Like I feel like this is the first of what we're going to see happening. And I don't know about Governor of California, but Newsom's time is up. So, you know, I'm curious who they're going to put in office there, or I'm curious who the nominee is going to be. But I would not be surprised if we get something very similar happening as well. Like, what if it's just the most outlandish party gets elected as the new governor of California? You know, because I'll tell you something, people in California, including myself, like, I don't like what's been happening for the last 6 months or however long Newsom's been in office. As far as someone in the middle class, because I don't make $5 million a year, I consider myself middle class. We all get screwed over. We pay higher property taxes, higher taxes across the board. And on top of that, the cost of living just goes up astronomically higher. And I know that this isn't anything that the government can just fix out of nowhere, right? Like there's obviously a lot of red tape that I don't even know about that just make it the way it is today. But at the same time, it's like, I mean, you piss off a lot of people, you're gonna get dealt the wrong hand that you don't want, right? So we'll see what happens. The end of California, I don't know, man. The United States of California, I honestly, I don't really care. Like, I'm gonna be so gone from California if that happens. Like, I don't want to be here anymore if that happens. Anyways, if there's gonna be a state that succeeds, it's gonna be Texas. I don't think it's gonna be California. So,
yeah,
you know, that's actually really. Oh, go ahead.
No, I'm saying like most of the problems when it comes to things like income inequality, they tend to happen under liberal and socialist policies. All right. Like, so people don't realize this, but the goal of socialism is to make everyone equal, but the end result tends to be very, very different. And if you look at how everything works out, like I grew up in New York City, and under Giuliani, we had this huge economic boom, and then Mike Bloomberg kind of did the same thing, and we had a really good time. I mean, you remember when we went to school at Stony Brook, everyone still would go into the city. It was a great place to hang out.
New York City, when Giuliani started, I don't think everyone knows, but there were strip clubs everywhere. There were drug addicts everywhere. New York was not a fun place to be in. Even places like Williamsburg and Brooklyn, which is right on the border of Brooklyn and Queens, like that place was homeless city. And then if you look at Williamsburg today, it's like the Beverly Hills of, not the Beverly Hills, sorry, not the Beverly. That's more like Long Island City, but it is completely different. You wouldn't even recognize. If you play San Andreas, Liberty City. If you play Grand Theft Auto Liberty City, this was back in like probably 2005 or something. The newer Liberty City that came out after that. So like maybe like 2008, right? Or 2005 actually. I forget exactly when, but you could actually drive to the area where Williamsburg is in, because it's basically New York City and all the 5 boroughs and everything. And like, it's literally like a bunch of homeless people and like burning trash cans everywhere. And it's like, well, that's what Williamsburg was back then, man. Like it's changed. You're right. Like it's changed a lot. And it was not under a liberal regime when that happened.
Well, the thing is, a lot of the liberal policies are, we need to make everyone equal. So we need to build more public housing. The thing is with public housing is that once you give someone public housing, the goal is to basically get people off of their feet and then end up going to work and eventually getting out of that need for social services. But humans, you know, we're creatures of comfort. We're looking at the easiest way. So what ends up happening is you give someone free housing and you're basing that especially on things like income. So all these people, their entire incentive is, how do I basically live a good life without having to pay as, you know, market rate? So if you look at New York City, like NYCHA has, I don't know, like crazy amounts of apartment buildings that they have. There's so much other things that are out there. So when you look at the total like number of housing units that New York City builds a lot of times, it's very limited because the city itself creates a lot of barriers to building new buildings, rehabilitating older buildings. Like there's the amount of vacant apartment buildings in New York City is astronomical because New York City has rent control in certain parts of it. So now the landlords, they're like, look, we can't make enough money to afford to pay for all the renovation work to make this livable. So all of them just keep those units unoccupied because they can't make it livable, right? They don't have the incentive to do it because they're not going to be able to rent it out and make a profit on it. So they leave them empty. And there's tons of things like that. So New York City itself has a lot of inventory that's in the shadows that, they should start to eventually come out of if the government actually, I don't know, whatever. The New York City and California, they're just, I'm not going to say anything else because I think there's
I know. I hate to get too political on these streams, especially financial streams. But I mean, I think we both kind of agree. Like this problem ain't gonna fix itself. And
New York deserves everything it's gonna get under. Like go ahead, elect the socialists. See how that works out for you. Maybe. Yeah, I know. Maybe it works out. Who knows? It's up to it's up to the people in the city.
It might work out, it might not work out, but I mean, I hope for the better. So I hope best of luck for what is that? How long is that? 6 years?
What
how long is the mayor in office for?
I think 6. But remember, they still have to elect. It's still Eric Adams, so it's not. Yeah. It's not like it's all over yet. So Eric Adams still has a chance to win it. So, but yeah, let's go over Carnival.
Yeah, let's go.
It's a little important. So Carnival reported earnings today, and let me tell you something. They had a monster quarter. If you look at their EBITDA literally for the second quarter was 1.5 billion, almost $200 million above what they were originally forecasting. Same thing with earnings, literally almost 200 million in earnings. So almost a 42% beat on EPS, which is crazy. And if you look at their margin improvement is amazing. And a lot of their targets that they set for 2026, they actually hit them earlier than they were expecting by like a wide margin, a year and a half. So now you can see in June guidance, they're actually giving higher earnings guidance that's going forward. So, they're beating on all accounts. They've got some major tailwinds with their new island, and the summer is, just ramping up right now. So they've got, a couple, this is their new island in the Caribbean. They've got another one that they're developing right now. And it's pretty amazing. But I think the highlight for me is the strategy that Carnival is using to basically utilizing the existing fleet that they have, because they have a pretty large fleet, and they're doing really well on maintaining their cost and using a lot of their savings to pay down debt at a really, really fast pace. So if you see their improvement on their net debt to EBITDA, when you start falling in the 3, like between 3 and 4, that's when you start getting back to investment grade debt. So if you look here, they actually went from BB negative to now BB positive. So all of this work that they did in getting their upgrades is going to be really positive for shareholders, because when you keep getting upgraded, think of it like your borrowing costs. The better credit you have, the lower your interest rates are going forward. So you've got 2 tailwinds now. One, you've got less debt on the balance sheet, and the other is the cost of that debt is going down significantly, which means more money is actually getting injected into the value of the company, and vice versa, shareholders. Eventually, these guys will get to a point where they're going to be at below 3 times on debt to EBITDA, which is going to give them investment grade rating, and it's going to be great for this company. I mean, they've got a lot of tailwinds on the horizon. So, I know a lot of people will be like, oh, the cruise lines, why would you want to be in the cruise lines? No, but they have a pretty good business. I heard
that BS for a long time. It's not the hot stock. And it's like, dude, the thing doubled. It doubled.
Yeah.
It's April, so I don't know what you guys are talking about.
Yeah, and same thing. I think Norwegian went with a little bit of a different route in that they chose to keep building more and more ships. So they didn't not work on lowering their debt. So, in terms of total savings for them, the market is not giving them nearly the amount of grace that they are giving Carnival. And if you see a lot of the debt that they have, and this was the thesis for anyone who was on the Patreon, this was the thesis a year and a half ago, where I think the market got it wrong, which was, hey, look at the debt that Carnival has. They have two sets of debt. One is they have a lot of high interest debt, and then they also have a lot of low interest debt that was issued prior to COVID, and also from agreements with the shipbuilders. So if you start to target that higher interest debt, you make a meaningful impact in the interest rate reduction. So that's exactly what they did. They were able to refinance a lot of that debt into much lower rates. And all of that is resulting in just a lot of savings for this company. And, they're going to get to investment grade balance sheet soon enough. One other thing, I don't know if investors really look at this, but it's a very important point. As you grow your business, some businesses have something called float, right? Where basically people give you money ahead of services rendered. So right now, Carnival has almost $8.5 billion in customer deposits. Okay. This is for like people that are booking a cruise a year and a half, 2 years out sometimes. That money is put into, a bucket that Carnival can draw on to do different things, lower debt, put it towards treasury so they could probably get some return off of it. But look at that jump that from second quarter of 2019 to second quarter of 2025. That is $8.5 billion in pre-sales. This is stuff that's literally a year ahead of time. So if you think about getting a 7, maybe even an 8% return on that capital, because remember, if you have debt that's maturing, debt that's like issued at 7, 8, 9%, you're able to take this money and pay down that debt ahead of time. What you're essentially doing is saving that 7, 8%, and you're getting you're basically getting free money. So you're borrowing free money and basically taking out high interest on $8.5 billion. That's almost $560 billion of interest savings that these guys have because of float right here. So, if you look at the business, 560 million based on that 8.5 at 7%, give or take a few million here or there, like it's literally goes right to the bottom line, $700 million in savings, So yeah, this is one of the things that people don't know about this industry that makes it so profitable. Yeah, there might still be some headwinds coming from some recessionary impacts, even though Jerome Powell says, oh, there's no recession. I still see some weakness in the consumer at the lower end. But for the most part, a lot of people, they love going on cruises, and it's working out really well for Carnival Cruise Line. So net income is going to be close to $2.7 billion by the end of this year. So
okay, so show us those gains.
I'm not showing gains, sorry. Yeah. But I have a lot. Well, I have a very big vested interest in this because it was a really, really thorough thesis that I made a long time ago, and I'm glad it's playing out right now. Because when I brought this up when it was like $12, I was like, oh no, cruise lines, but the business is a really good business. So
the funny thing is that you said you brought up when it was $12, but people had an opportunity to get in again.
Yeah.
just last April, it was $15. Now, handed, there were a lot of deals last April. Okay, so this is April 7th. This was like after futures open at its low, right? Could have gotten here, could have gotten here, could have gotten. You still could have gotten here, right?
Well, the thing is, the main value of this wasn't the stock; it was the options, right? It was those long dated options that were completely mispriced for a recovery. And so anyone who got into those options at the prices that I did, you're sitting on a lot of gains right now. So,
all right. So let's see here. I'm about to do it right now. I'm going to do it. I'm going to whip out the options calculator.
Go for it.
All right, let's do it, man. Let's do it. Let's calculate what the options were when you got it. Oops. No, I don't want to share that one. I want to share the tab, girl. All right. Here we go. So let's do it. All right. CCL. All right. So you got and I'm going to say what they are because, like, obviously, you know, the juice has been squeezed a good amount at this point. So I don't care if we're kind of giving away what the move was here. But all right, let me make this a little bit bigger. Okay. So we got the January 2027. Sorry, the December 2026. And then what was the strike?
20 and 35.
Okay, so wide
and that's fine. The entry was $2.
So today, where is it here? It's worth $6 right now. So they are up 200% of the value. Okay, so now let's take a look here. Let's see what happens if it goes to 36 bucks. And let's just say that happens by the end of let's say it goes to 30 bucks. Let's say that happens by September, right?
Yeah.
So then that means that hold on a second here. Oh man, I haven't used this calculator in a minute, so I forgot exactly how. Hold on. I'm trying to figure this out in real time. I think it's in a graph. Oh, here we go. This is what I'm looking for. Okay, so 30 bucks. That means that.
So the thing is, remember, it's going to cost you $6 for the spread. So the spread is $15 wide. If you pay $6, your total gain is not going to be as high. So
no, I know what I'm trying to figure out the contract value. Oh, here we go. This is what I'm looking for. Okay, so at 30 bucks, it's going to be worth $10 for that contract. Right. So that would mean that you made 400%, you 5 times if it goes 30 bucks.
Yeah.
All right.
And look at what happens when it's 35.
But this is at expiration. So let me actually go back here. Let me go to, let's say realistically, you know, if we keep heading the right track, we have 2 rate cuts. This thing's going to keep going up. Right. So November 18, if it goes to 30 bucks, it's only worth $8. But still, you know, that's a 4 times, which is great. And, you know, the way that debit spreads work, and people don't know, is that you need to be closer to expiration in order to realize more of the gains because the intrinsic value and extrinsic value, and I don't want to get too into that right now, but let's say March 30th, right? So if it goes to 30 bucks, it's going to be worth about $8.50. Honestly, by that point, it might even be $35. And if that happens, it's going to be worth like $10.50. You're probably, I mean, depending on like how much this goes, I think by that point you would probably manage your risk.
I usually 180 days usually is when I try to start moving out of the position slowly. So
that would be June of 2026.
Probably September-ish, I'd say. Between that summer, basically.
So September, and what's your price target in September?
About 35.
35 bucks. All right. So you're going to be looking at a 6-bagger.
Yeah.
Yeah. And then that's probably when you downshift and collect the profits, right? So
correct.
The way that strategy is basically working is that he's going to probably buy back the $35 short calls and then roll it down to a closer strike. So let's go back here to this chart. I'm going to exclude this value. And what would you sell?
Probably the $30 calls. Probably the $30 calls.
Okay, so we're going to sell the $30 calls. We're going to look at the same charts at 35 bucks, and that's going to be $8.50 about. So that means that you would lock in your initial investment, right? That's what you would be doing. You lock in your initial investment because that's a difference of $2, and you pay $2 for the contract. And now that new contract is worth $8.75. The max profit at that point is about $1.50 a contract. And I'm doing this all in my head because I'm changing the amount there because that's just show the net debit is how much it is today. But at that time, that contract could be worth $8.74, and that full spread is $10. So the maximum you can get is an additional $1.40. And by that point, I mean, you took out your initial value.
Yeah.
In order to lose this bet at that point, Carnival would have to drop down below $20 by expiration, which is very unlikely to happen, considering that by the end of 2026, the Fed is anticipated, based on their summary of economic projections, the Fed is anticipated to be 3 rate cuts down, which is like 3.75%. By that point, Carnival would definitely be refinancing the higher debt and probably printing much more cash flow. So we're looking at how much of their cash flow grow last quarter?
It wouldn't matter, because the thing is, they're not adding much ships. The only thing that they're going to have is their EBITDA is going to climb from higher pricing and from the new sales from its new island, basically. So it's really hard to basically project that out, but you're looking at an EPS between 225 and 250 next year.
Yeah.
And if you look at if you look at the multiples on it, it's usually about 50. Yeah. It's usually between, I would say 15 is about right. So 15 times, let's say 2.35. And that's the target that you would run into.
So if you think about it in this case, you got to basically a 10% profit margin, but at the same time, net margin. But when you think about that, in that case, also is that you're saying they're going to reduce their cost of the operating income would be a substantial amount as well. And, they're obviously they're not noobs when it comes to financial engineering. So they really know how to work this out to increase the bottom line and so on. But at the same time, the way that I'd see it is that did they restart their dividend?
No. Their focus.
If they do that,
their key focus right now is debt reduction. They want to get to investment grade. So just from that perspective alone, this thing should be $35, $40. Because the thing is, the more debt you take out, the more your valuation on underlying price goes up, right? So that's the thing. So now your debt to EBITDA. So their main focus is getting that debt down, and it worked out. Unlike Norwegian is fixated on growth. So Norwegian is like, we're going to grow ourselves out of our debt. Carnival is like, we're going to pay down our debt. So as long as interest rates,
Norwegian is basically doing what Trump is trying to do, and Carnival is doing what Trump should have done.
Kind of, yeah.
Norwegian's trying to grow themselves out of their debt.
Yeah, I mean, if you think about it, the more debt you pay off, the more likely it is that you're a credit-worthy borrower or issue, or whatever you want to call it. So it ends up creating value for shareholders. Now, do I think eventually they start their what is that thing called? Dividends? Yeah. I also think they might eventually start doing buybacks again, but that's not until at least, I would say, the end of 2026. I think at the end of 2026, they would reevaluate everything. And if the stock was still undervalued, sub 14 PE, it's more likely that they'll do more buybacks than they'll do dividends. Because the thing is, once you start the dividends, it's hard to kind of wean off of that. But anyone looking to hold this thing long term, still, there's still opportunity. I wouldn't say it's the greatest opportunity where you're going to see huge amounts of growth, but it's still pretty good.
I don't know if people remember, but before COVID, Carnival was a very good buy and hold stock. It was trading near $70. Okay. Paying the dividend, consumer strong, people are going on cruises, which, if you ask me, a lot of people are still going on cruises as well. If you return that sentiment and you start hinting that, hey, we might return the dividend, we might start just even talking about it, because they don't have to actually do it in order to see the appreciation on the stock based on Wall Street trying to front run it. But if they start mentioning it on a call that they're thinking about doing it, dude, the thing's going to go up 10% after those earnings. Yeah, just the fact that they might restart their dividend.
The key is, like I said, I don't think they're going to target their dividend anytime soon. The debt is the main concern right now. They also had to issue a lot of shares. So, they want to get that portion down. So if they want to get back to their 2019 and, levels, they got to focus on what they're doing right now, which is executing. And it's doing well.
Yeah, that's good. That's good.
Yeah. I like what Libro said. I sold my NCLH spreads during the April dip for tax loss harvesting and got CCL spreads instead, working out. Nice. See,
Nice.
That's why people are doing well on it.
We're talking about Carnival Cruise Lines. That was a pick that Kris had for quite some time, and it's really funny because like I remember it didn't perform for a little bit after you got in, and there was just like so much. People like mudslinging at you because it was like, oh, look at all these stocks going up in car. It's like, brother, just wait, right? Like you're not going to see the gain. And then like, look at what happened today, right? And like you were leveraged up the A on this thing. So that's good to see, man. That's good to see. So,
well, there's one thing that's actually kind of important. Up until now, Carnival has benefited because of the higher interest rates. Because, if you think about the strategy wise, and Norwegian has been kind of put in the back burner. But if we do get rate cuts, Norwegian's strategy is going to look a lot more attractive because at that point, debt is not your problem. It's the growth that's your problem.
There's going to be a lot of good strategies if we start getting rate cuts again. Like it's not just going to be cut. We're talking about like Tesla probably hitting new highs. We're probably talking about Amazon hitting new highs. Every single consumer discretionary stock you can possibly think of, which I think the market is actually pricing in. Because if I pull up a chart of see here, XLY is a consumer discretionary ETF. 40% of this is Tesla and Amazon. So this is very heavily weighted in those two companies. And we haven't hit the highs that we hit in last December because, of course, Tesla and Amazon are still probably about 10-15% away from their highs for Amazon. Tesla is like 30% away from its highs. But look across here in 2022. We're at 2022 levels. And the reason why is because rates are still high. So therefore, consumers are not as strong. Today, the consumer confidence report was like one of the biggest misses we had. Like the actual was 93 and it was expected to be like 99. But the market didn't care because the market does what it does. But you look at this chart. If we get rate cuts, this thing is going to be like way past all-time highs. But it's an interesting thing today because today you have financials basically near its all-time highs. And then today as well, I think XLK is near its all-time. Yeah, XLK made a new all-time high today, pretty much on the back of NVIDIA and Microsoft having new all-time highs. Apple is part of this as well. So, we haven't even seen this behemoth move, but I do think Apple is probably going to be heading toward its all-time highs if that news of Perplexity does actually come to fruition, that Apple is going to acquire Perplexity, which I think they should do it. I think that's the best move they could possibly do right now just to keep them relevant in the AI race. But if they do, I think I might go for leaps on Apple just because of that. But we'll see. I haven't decided yet. Anyways, just think about like the crazy sentiment there is right now.
Yeah.
This chart is insane. Like just Robinhood is the chart that I want Grab to look like. I want Grab to look like Robinhood. Eventually, we got time with Grab, but like Robinhood is just wild. And this is really on the back of the stable coin and crypto becoming a financial payment system. When you really think about it, Vlad was on CNBC talking about crypto becoming the norm for financial payment systems. And I actually want to play that clip. Vlad was on. He was on CNBC this morning, so I'm going to go ahead and share my screen and play that for you. All right. I'll put the link over here in case you guys want to check that out.
Right. And in the second lens, it's the next stage. I do.
Where's my sound, girl?
There you go. You're good. I can hear it.
There's two ways to look at it. One is tradable asset like options, futures, and equities. The other is as a fundamental underlying technology.
Right.
And in the second lens, it's the next stage in evolution. We've gone from, paper and pencil, filing cabinet-based financial services to mainframe to
so weird, I can't hear
on-premise, and then more recently cloud. Now, crypto is the next stage in that, where a lot of the business logic that we've required businesses to actually build is now shared infrastructure. So exchanges, lending pools, payment processors, all these things are replaced by software. So I think in the future, crypto technology will power trading and all sorts of financial services, including trading in stocks and other TradFi assets. So the two will fully merge. I do think that crypto itself, there's two ways to look at it. One is a tradable asset like options, futures, and equities. The other is as a fundamental underlying technology.
Right.
And in the second lens, it's the next stage in evolution. We've gone from, paper and pencil, filing cabinet based.
Can you pause this for a second?
Mainframe to
CNBC is such a dick. Did you see that? They just put Robinhood and Coinbase next to each other just to highlight how much better Robinhood has done.
Robinhood has doubled. Coinbase is just catching up because they get some of the revenue from Circle. So that's just going to happen. But CNBC's brought up the ratings. Of course, they're going to do that.
To on-premise and then more recently cloud. Now, crypto is the next stage in that, where a lot of the business logic that we've required businesses to actually build is now shared infrastructure. So exchanges, lending pools, payment processors, all these things are replaced by software. So I think in the future, crypto technology will power trading and all sorts of financial services, including trading in stocks and other TradFi assets. So the two will fully merge. I do think that crypto itself, there's two ways to look at it. One is a tradable asset like options.
Yeah.
Yeah. You see a lot of these bills passed with crypto. You see a lot of the moves that a lot of these companies are making towards stable coins. It's going to happen, whether you guys like it or not. It's going to start becoming a payment system, especially when you have a lot of pegging going on, when you have a lot of companies, especially Coinbase, becoming custodians of a lot of stable coin and a lot of crypto. It's going to happen, guys.
The question is, how do we monetize? How do we monetize?
We are monetizing off it, son. We are monetizing off it.
No, I'm saying what do we need to buy to get a piece of that? I want to find
Bitcoin,
the Visa. I want to find the MasterCard. Bitcoin is supposed to be the gold. I'm talking about, what do you buy today in the cryptoverse that compounds on itself, because just having ownership of it gives you a return. And as the network grows, you get bigger and bigger cuts. That's the key.
This is the reason why everyone needs to own crypto. I'm not saying go full port crypto. That's crazy. But this is the reason why people need to own some crypto in their portfolio, because no matter what happens, crypto is basically your S&P 500 of all of cryptocurrency, period, right? I don't know what Ethereum is going to be. I don't know if that's still going to be around or anything, and we could have the discussion at some point about the other altcoins, whatever. But crypto is literally the gold of this entire crypto wave, right? So I'm not saying I'm not saying Bitcoin is digital gold, because that would be outlandish to say that. Like if the NASDAQ got cut in half, crypto is going to be near zero. Crypto is basically a call option on the market. But at the same time, if you really want to reap the benefits of this, you pretty much could just buy crypto. Now, if you think about it from a stock perspective, I think PayPal is probably going to go on a crazy run if this stuff really goes into effect, because PayPal is going to be one of the mediators of this payment system. But at the same time, it's also going to be Robinhood, because they're going to try to go for that. You could already see even XAI, they're probably going to eventually go for that too. Maybe they're going to use Doge, whatever it is. But, this is kind of the direction it's headed. And Visa is already considering doing this stuff too, just to stay relevant in the game. And honestly, I don't think Visa and MasterCard are going anywhere. I think that's a very safe bet to have in terms of revolutionizing payment systems. But Vlad knows how to talk his game, right? That's the reason why his stock is pumping, right? His stock is pumping right now, because he knows how to talk, right? He's like these other CEOs, Alex Karp and everything. They know how to talk to the audience and sell their own product. And, maybe they're not going to be the leader in this whole situation, but at the same time, he knows how to talk to these people and he knows how to sell. And that's the reason why this thing is hitting all-time highs, because of that fact, but also because they are releasing a bunch of products over and over and over again every single month. And they're getting a lot of people signing up for this stuff. They've been the custodian for a lot of money that's just never going to leave, frankly. And if you look at the amount of net deposits they have, that thing just keeps on going up and to the right. And honestly, the quarter that they just reported did not cover the recovery from April.
Yeah,
the quarter that's coming up is going to cover that. And do you know how much trading there's been? The amount of fees they're going to collect from all that's going to be insane. And I think that's what the markets are front running, because they know that they're sniffing that out. And boy, half of my shares might be in trouble. Like I had way out of the money covered calls. I'm getting pretty close now. And like, what is happening right now? But I think I'll be fine with that at the end of the day. But I mean, dude, this is it's an interesting time to live in. Probably, I don't know. At this point, I think it's not reflected in my Savvy Trader, but I think Robinhood is going to become one of my biggest positions now, just because of its appreciation in the spreads, but also the shares too. And it's crazy because I didn't think this was going to happen, but it just is, and it's great.
Yeah. I was supposed to buy it when it dipped to the 30s, man. I thought about buying it, but I went with the TLT route instead, and that didn't work out nearly as well as the hood spreads, because that would have been the right.
If you bought the hood spreads, you would have went hard on the. I bought hood spreads, but I did not go hard on it. I wish I did. Yeah, you went pretty hard on ASTS, and that thing has just been tearing it up, man. Even I didn't expect it to be at this level anytime soon, and it just keeps going. I think it's been up like 15 of the last few days. Let's look at a chart. Let's look at a chart real quick.
Yeah, ever since I did that podcast with Amit, man, that thing was just amazing. Like literally, we caught the bottom on that one. So
that was insane because that pullback like basically gave the whole setup, and I didn't really add on that pullback. I just sold a lot of put credit spreads. Yeah, so this is a weekly chart, right? And probably like around here, it was like days before the thing just took off.
Yeah.
And this chart's wild. Like, is it justified? Is this current valuation justified? Like, how can anyone justify this? They don't have the recurring revenue yet. It's getting pumped because it's the market pre-recurring revenue. And the market front runs it.
Yeah.
But
they've got a lot. I told you they have a lot of catalysts on the horizon. I think that's why. So, people are just in a position where they think, you know what, this is going to happen. That's going to happen. By the way, someone asked about Marvell. Yeah, it's in my ETF. I don't personally hold it. I am thinking about buying some Marvell though. I should have.
I could talk a little bit about Marvell because I just added to my position. I actually had it in my portfolio for probably as it was going down. So my average is still above this, but if we adjust calls that I played on it, I'm actually well in the green on the actual adjusted basis. But Marvell is, hold on a second. Where's my stuff on this? I actually was going to talk about this on the next episode, but I feel like maybe I should, or should I hold off? The only thing is that actually I might as well just pull up the chart since we're already here.
Yeah.
Okay, so this is the chart of Marvell. Clearly, we're still very off from its all-time highs, but to be realistic, we are pretty well off of its lows. So I don't want to give people the wrong impression when it comes to Marvell that this thing is going to like make new all-time highs soon, because technically speaking, they aren't like a super profitable company. They are 50% off their lows. But the thing is that their earnings last quarter were not that great, right? And I got a little bit worried because I was thinking like, dude, is their growth story over? Like, are they really going to slow down in their growth in the midst of like this data center expansion? So there was a recent news, not necessarily news, but there was speculation from an analyst on Wall Street. Let me go to.
I bought them because the NVIDIA partnership.
You own them?
No, I'm saying like I bought them in my ETF, like that whole thing. So Marvell, yeah.
What NVIDIA partnership?
You don't know?
Was it a significant partnership?
Yeah. Here, let me pull it up.
Hold on a second. I just want to show this one. All right. So this analyst says that Marvell so they had AI Investor Day, which they replaced for their annual shareholder meeting. And when they actually did cancel that shareholder meeting, Wall Street got very bearish on it. So like that was an opportune time to add. But basically, they've mentioned that they have two emerging XPU customers. XPUs are specialized GPUs for a certain type of process. When you think of Google's TPUs are GPUs that are specifically catered for Google search queries, right? XPUs is basically a component inside these GPUs that are used for custom silicon that these companies do create. And they haven't said what these two companies actually were, but they've mentioned that they are large data center build outs. So not necessarily hyperscalers where they're renting out compute, because they didn't really specify that, but large data center build outs. This analyst is speculating that those two, because they build a lot of 2 nanometer chips and a little bit less than 2 nanometers. So XAI is planning on fabricating their own silicon or designing their own silicon, as well as Oracle is planning on doing that as their own. Oracle actually came out with that news today that they were, and that's the reason why Oracle is back at all-time highs. So this analyst is anticipating or speculating that Marvell is designing these chips for them, much like how they helped Amazon design their chips, how they've helped Meta design their chips, and it also how they helped Microsoft design the chips for Azure. So they're speculating that they could be designing these chips for XAI and Oracle. And if they do that, the stock's going to run. That is not baked into any of the guidance that they provided as far as the whole year. If they start doing this, they're going to get upgrades across the board with this. This is why this analyst increased this price target to 100.
Look at the thing I sent also with NVIDIA.
Okay, so NVLink Fusion is basically, I just want to explain this to you. NVLink Fusion is basically the NVLink is basically the network bridge between all the GPU clusters connecting to all the components inside a server or a CPU, CPUs, whatever it is. It's basically kind of like the spine of the entire system. And then you have the GPU, which is, I guess, in today's world is considered the brain, and all the processing power in it. But then you need to connect that brain to everything else inside the body. And the spine is technically, in this case, NVLink. And NVLink Fusion was built and was released or announced in the last, the NVIDIA GTC conference, where NVLink Fusion is going to be able to connect not just NVIDIA GPUs, but pretty much almost any GPU from any manufacturer and include that in an NVIDIA cluster or a GPU cluster, which is basically kind of widening NVIDIA's moat, because now it's saying like, well, you don't have to just buy our GB200s or our B200s or Blackwell chips in order to create your GPU clusters. You can put Google TPUs in there. You can put, whatever other kind of custom silicon you want in there, but you have to use NVLink Fusion in order to use it with the NVIDIA GPUs, right? So it's still keeping people inside the ecosystem, because the NVLink and CUDA are basically controlling the entire ecosystem from a software perspective for CUDA, right? So you're still in NVIDIA. It's like basically having an iPhone and an Apple Watch, but using like Beats. Actually, no, Beats is kind of, is Apple own Beats? I don't know, but basically using like
Apple owns Beats.
Oh, Apple owns, okay. So basically using like earbuds from like another company, right? You're still on Apple's platform. You're still using an Apple's ecosystem, but you're just using like a different type of earbuds, right? So this is kind of the same thing that NVLink is doing, where NVLink is kind of your smartphone. Your watch is like a GPU, whatever it is, but basically you're still in Apple's ecosystem, and CUDA is the iOS platform, and you're connecting your AirPods to CUDA, which is connecting to pretty much all of your other products. You're still in NVIDIA's platform. So what this is saying here, because I'm just reading this part, custom silicon with NVLink gives customers a flexible, high-performance foundation to build advanced AI infrastructure delivered. You don't actually have to go through this, but this is basically saying that Marvell is going to be able to be integrated with the, or going to be compatible with NVLink Fusion. I don't know. I mean, I feel like that was kind of expected to happen. Like, if you wanted, if you want to be part of pretty much the entire GPU cluster that most of the world is going to buy, especially data centers, like you want to be compatible with NVLink Fusion. I don't know. I have to look at this article, but Marvell was up like 5% today. I think that's on the back of speculating that XAI and Oracle are going to be their two new customers that they haven't mentioned names of. And if that happens, that's going to be pretty big, because that's literally going to add much more to their data center revenue, which is literally just growing at like 75%, right? So if that happens, that means that the revenue is going to reaccelerate for the data center. That means all the revenue is going to reaccelerate. And that means that they're going to get re-rated a bit higher, because Wall Street is going to have to, of course, increase their price targets and then increase their estimates. So with that being said, if you see all these data center stocks going up and then Marvell is still down there and they're bringing on clients that haven't been mentioned, that's kind of like something that's not baked into a stock or a narrative per se. That's going to help the stock get re-rated. So am I making options play on Marvel? I don't know, man. Maybe join the Patreon. We can talk. You are on the Patreon. So I haven't decided yet. So it would
we'll
be
do
nice
more
to get in
DD
that
and we'll
first deal.
discuss.
I would rather do a bit more research and just like outlandish say like, I'm going to throw this in there. But if I'm going to do an options play in Marvel, I want to make it a big position because I have pretty high conviction that if the market stays bullish, market has to stay bullish. I think Marvell is gonna go to $100.
Yeah, I would rather. Someone's asking Marvell or Micron. I personally would rather go Marvell than Micron. Micron, I don't even know why even get such a big premium.
Micron basically makes the high bandwidth memory, or I think they're on like HBM4 or something. I forget which generation, but they basically make the memory that is the memory for GPUs and for systems, right? And the reason why that they're getting such a high bidding is because the data center build out is getting reaccelerated, and NVIDIA actually is a client of Micron, and so are a lot of other companies. Like this is, I wouldn't say they're de facto because it's a pretty competitive space with SK Hynix also building those as well. I wouldn't want to say Samsung is because Samsung is kind of getting like a little bit weeded out, but SK Hynix is a pretty big competitor for that against Micron. But at the same time, I feel like when it comes to this thing, like Micron is already, even from like a stock chart perspective. Let me just look in here. Wow, I got to show this. I got to show this chart. I mean, Roger's right. There's definitely going to be demand for it. And I'm not saying it's not going to keep going up. All I'm saying is that the thing already ran so hard that I think the opportunity to buy it had already passed. So if you look at this chart, Micron's already at 128. You had a lot of time to accumulate shares under $100, and then you had an even better time in April, which, again, there are a lot of things that were on sale during the time, so you can't really blame you for not buying. But after a stock does this to buy leverage call options on it, it's just so difficult to make that case. Like I would personally rather buy something like this that's still in somewhat consolidation phase than buy this. Like, and two different companies, Marvell fabricates chips, works with networking as well. There's also a bit of anticipation that they might find another tailwind in terms of its network infrastructure build out as well. And that's also going to be another driver when it comes to AI data center build out. It's not just the GPUs or the custom silicon or ASIC chips. It's also the networking segment, which is the reason why you've seen a company like Arista Network, which is actually a profitable, reputable company. When it comes to building, basically a competitor of Cisco. When it comes to actually building on network hardware and then getting into that software realm as well. That's something in that space. So that's a whole different discussion, but you have a lot of these network build out companies, data center companies like Nebius going on crazy runs. Of course, everyone's heard of CoreWeave as well. That is definitely not CoreWeave. Yeah. Like this, because they're all getting ahead of it. They're all trying to front run it, and the market's trying to sniff out other opportunity to get in there. And you even see like AMD is almost back at 140 now. Like this is what Wall Street's looking at right now. They're looking at semiconductors. If I bring up a chart over here, the SOX ETF, dude, the SOX ETF is getting closer to highs than it was last July. The SOX ETF has been in a massive bear market for a long time. And look, it's like about to break out here. Like Wall Street's chasing this stuff. So it's very difficult to chase the stuff that's really been working. If you want to think about leverage, when you want to think about leverage, you want to get stuff that is about to take off, but not things that already did, because then you're just scalping at that point where your risk reward starts to minimize a little bit. And the options are already a lot more expensive because then the IV is a lot larger because it already made a big move. And therefore the contracts have a lot more premium than you'd pay. So you're basically paying that premium up front, right? So shoot, it's already been an hour. I did not mean to get into Marvell because I wanted to talk a little bit about Nubank. I mean,
we'll save that for next time.
We'll save that next time. I did kind of want to talk a little bit about HIMS. Nah, dude, this is just me. I haven't drank any caffeine since earlier today, man. Of course I'm on fire. It's Hidden Ed Pod. We're on fire all the time, man. Anyways, appreciate you for joining. But yeah, it's actually really funny because like in the back of my head, I know like Raj knows a lot about this space.
Yeah.
And especially when it comes to like data center components. And like one day I like wanted to have him on here, just like pick his brain on it because he really knows a lot about this stuff. But no, I mean, Pedro's right. Like there's a lot of good chip companies out there, but there's also a lot of crappy chip companies out there, right? So when you're buying something in the semiconductor space, it isn't going to raise, the tide is not going to raise all the boats. There's going to be some crappy boats out there that should not be raised, and it's just not going to reap any of the benefits. But at the same time, I mean, if you have clients that are basically the largest hyperscalers in the entire world, and that largest hyperscalers are spending money out of their nose, you don't need a lot of it when you think of a smaller company in order to reap some of those benefits. That's the reason why you've seen Nebius run so hard, because it's not the number one data center build out company in the entire world. It's not even like owning all the data centers. It leases a lot of the data center space and leases some of the land as well. Like they're not going to reap all of that $2 trillion build out TAM that Jensen Huang's talking about in 2030. They just need a little bit of it. Like they're like an $8 billion company. It's not that big. And I think there's a lot more to build out in this scenario, right? Like if you think of all the demand that's being built out there, unless you're some guru who sees like the whole world collapsing in 2 years, like this is all going to go to zero if that happens, which in that case, you don't have to worry about your portfolio. Like we're going to be at war or something. Yeah. But dude, the amount of CapEx being spent left and right on all this stuff, like how can you be bearish this scenario? Like it's so difficult to be bearish all this, even at a point like, I didn't believe it, right? In like early 2023, you didn't believe it for a minute. You thought this was just an AI hype wave. And then you looked at the data, you dug into the companies. It's like, this is very real, right? Like this is very real. And it is, this is real. Like this,
you're starting to see all the use cases starting to come. I mean, you've got robotic taxis out there right now. What do you think powering all that AI infrastructure? It's all NVIDIA chips that are in those cars, I mean, it's all, think about how many things, robots, you're starting to see Figure Robot and all these other robots come out. What do you think's powering all that stuff? You've got all these like image generation, voice generation, coding. What do you think all that comes from? That comes from all these chips, so yeah.
I mean, like this is also the thing with Tesla, the robotaxi event. And I have to say it, okay? Like, obviously, people had an expectation of what they thought the robotaxi was going to be. They thought it was like literally going to be a friggin' Tesla pull up, and there's going to be no one in the car, and it's going to take you from point A to point B, and you're going to be good to go, right? Was Waymo perfect when it came out? And Waymo is not even perfect today, but they're going to figure it out. They're going to build it out, and it's not going to ever be perfect, but it'll get closer to perfection as time goes on, because that's just what software engineers do. They improve things. That's what product engineers do. They find things that are wrong. They build it, and you have to put it in a real world scenario in order to find these little tiny obscurities and failures. You're running quality assurance on it. You're running QA testing on your robotaxi in a fixed geofence environment, and you want things to not work so you can fix it, right? And it's getting so much criticism left and right. And it's just like, what did you expect was going to happen when this event happened? Like, did you expect it to be perfect? No. Is it going to be better in 2 or 3 years? Yes, it's going to be better. And it's probably not just going to be in Austin. It's going to be in other places. And they're probably going to scale out much faster, in my opinion, than Waymo is, only because they have the backing of the richest guy in the entire world. But they also have the data too. They have multiple amounts of data that Waymo has. Tesla's been collecting since the early 2010s, and probably even before that, for all we know. They have the data to have their algorithms learn and their large language models learn from. And the data that he's been collecting for a long time has been processed in real time the whole time, which means that data is more usable than the amount of garbage that these other companies are collecting, right? Tesla's ahead of the game. They're ahead of the game. I'm sorry. Like in 5 years, Tesla's gonna be doing some crazy stuff with their cars. Okay. And I'm not saying Waymo is going to be behind them. I'm just saying like Waymo is going to be a duopoly in the scenario. But at the same time, like I still think Tesla's very far ahead, and that might not be like the absolute case today, but they're going to be able to accelerate a lot faster in my opinion, because that's the only thing that they're focusing on. They've been focusing on it for a while. They don't have, it's like basically saying, think of the satellite 5G connectivity you have with ASTS, right? You don't need a modem for it. Okay. The reason why Starlink is getting a lot of hate for it at its current juncture is because you need a modem for it. So when you think of Tesla,
let's rephrase it. You still need a modem, but you need a cellular modem for the ASTS. Whereas with the Starlink, you need a like direct line of sight like modem, right? Because they're still modems.
Yeah, but the metaphor I'm trying to, the comparison I'm trying to say is that with Tesla, they build a car, and then besides software, it's perfectly capable of working on vision, right? And just full an FSD. When it comes to Waymo, LiDAR requires all of those components on it. Yeah. So that car is like a $200,000 plus car. Tesla is a $40,000 car, and they're already building them at scale, right? So
but here's the thing, Sam. Even when it comes to LiDAR, prices of LiDAR are going down significantly, and there's a lot of benefits that LiDAR has that I refuse to believe that everyone at Tesla is 100% based on just vision. Because my thinking, especially with LiDAR, is that there are a lot of things that LiDAR sees that normal vision can't. Like, here's an example today. Waymos were running in the rain. Tesla stopped. They're like, no, we like vision could get clouded, right? With LiDAR, you can cut through fog. So how do you replace that? How do you change from vision to that?
I mean, do we have LiDAR vision ourselves?
No, we don't. But that's the point, that we're trying to make this car safer than what humans are, right? That's the whole intent behind this thing, which is get as much safety in this as possible. Not, hey, let's get to the human level. Like, bro, I don't want to be a human. I want to have extra.
I don't want a human driving me around. I want a robot. So you'd rather have a robot driving you around than a human.
Well, the example that I can best give is that there was more than a few times where the Waymo, because of the way that it has the LiDAR, it was able to actually kind of see movement around obstacles. And so when that moving target came, the Waymo stopped way ahead of time. If it was a driver, it would have hit that target, guaranteed. And the Tesla might have actually hit the target because it was not in the vision at that point. Waymo was able to course correct it because it sensed it way ahead of time. You know what I mean? Like, there are reasons why people get into accidents because they don't see things. Why should we limit the next generation of autonomous cars?
I would actually argue with that, because part of the reason why people get into accidents is not because they don't see things. It's because they see it, but they're not able to process it and through their brain as quickly and react to it as quickly than a machine would. So if you think that, let's go back to the conversation about data. All right. It's not just one human collecting all of our experiences and basing that as we sit behind the driver or the wheel as we drive our car, right? It's the collective intelligence that's been taken from every single car around the entire world that's a Tesla, and then use that to compute the decision it's going to make in less than a split second, less than a millisecond. Now, that capability is not human. That capability is obviously robotic. And that is where the juice is when it comes to all this. Right now, it's in a real world scenario. So, of course, it's not going to work perfectly, but I think it eventually will. And then once it gets to the point where it surpasses, like, think about Waymo improving probably at like 50 miles an hour. I think Tesla is probably improving exponentially because it's all being scaled out and it's much cheaper to build these products. There's like there obviously is way more Teslas on the road than Waymo, right?
Yeah.
There's way more Teslas.
So there's going to be a lot more training data. Yeah. No, that's 100%. But once again, all I'm saying is maybe this is the one time Elon Musk should fold and actually include some LiDAR sensors in there. And yes, would the cost go up marginally? I think so. I think some of the cost could theoretically rise a little bit, but it also means that you get a safer product. And I think from a regulatory standpoint, I think that's why Waymo is doing so well, because it's been able to show and demonstrate a lot better safety. I mean, right now we can't really judge safety based on that, but a lot of the people that I spoke to when it comes to owning their Teslas and FSD, they still tell me like, hey, there are still a lot of issues with their Tesla on full FSD where they have to
I'm not going to argue with that. I'm not going to argue with that. No, there's obviously a lot of scenarios that Tesla has been able to figure out when it comes to that. No, of course.
And if the end goal is, hey, we're not going to put LiDAR because it's cheaper, that's the option we're going to go with so we can scale up. Dude, just figure out how to incorporate LiDAR and then scale up.
Well, then that would be completely pointless in the whole scenario. They'd have to throw away all their applications and basically rebuild everything from scratch at that point. And then on top, that wouldn't even be worth it because it costs so much more. It's always the cost when it comes to this.
But that's what I'm trying to say. If you look at the cost of LiDAR, it's going down significantly right now. If you look at
but if you think of the cost of Tesla, that's going to go down too, especially since they're scaling out way faster than Waymo.
Dude, I think Waymo is scaling based on the needs of the markets that they're entering. Okay, they don't need to be in every single market replacing every single car all at the same time. You know, this is sorry.
I didn't want to get into the argument that there's only going to be one winner because I said it before, like it's going to be duopoly. Like there's going to be Waymos and these Teslas around. But what I'm trying to explain the bull case for Tesla when it comes to FSD and setting the expectation of what that was kind of skewed before the robotaxi event versus today, I feel like it's kind of unjustified because people had this crazy expectation it was going to work out the door. And the first iPhone was not a disaster, but it was not nearly as good as the iPhone 5 generations later. Right. Yeah. And if you think about Waymo's been on the road a lot longer than Tesla. This is the first time that they're using robotaxi or an unsupervised FSD in any real world scenario to the general public. The only time that they've tested it outside of that was in like I don't know, whatever track that they were doing on. Maybe they had like one car on the road with like 20 people watching it or something. But this is like the first like actual real world scenario. And I think that it's going to get a lot better very quickly. And I think that when it does get a lot better very quickly, the stock's probably going to run before you even get a sniff of that because Tesla's just a crazy momentum stock. You know, I think that that's part where we got to kind of separate the difference between like the stock price and the actual company itself. Yeah. You know, like if the stock price hit, they're figuring it out, like the stock's going to be like $500.
The other thing also is that, you know, Google right now is partnering with Jaguar to do eye-paces. They've also partnered with Hyundai. They've also partnered with another Chinese EV maker. So even the cost of the cars, they're not going to be like, hey, let's take a Jaguar I-Pace and add LiDAR to it. They're going to be purpose built. And I think that's one of the things that people may or may not get about this Waymo generation, that the next generation of cars may be like taxis might be purpose built specifically for this task. And by that time, you could actually scale things up. I think this notion that Google does not know how to scale like things up and Waymo can't scale, I think that's a misnomer. And I think that's something that we'll see in the next like 2 to 5 years.
I never said Google was not going to be afraid of it. Like Waymo, I don't think that's going to attract enough revenue in order to actually like make an actual dent in their existing revenue they're getting right now, but it probably will in like a few years, right? Like I think that people aren't really calculating that part when it comes to Google. And again, like I don't think that it's a winner take all. Like there's always going to be both. There's going to be, and one of them is going to serve a much better purpose, a certain task versus the other one, right? So if we're talking about like driving in a metropolitan area, you know, in this case, obviously Waymo wins in that scenario. But if you think about like sending a freaking semi truck across the country to deliver like, you know, two containers of product and then taking the human out of the equation and just having that truck just drive the whole time on a battery, you're talking about a lot more efficiency there. And going back to the conversation where we originally started on, where we're talking about the amount of processing that's required to do all this, like I think the fact that all these companies say that the supply is not meeting demand in today's scenario, I think that just kind of says everything for like a few quarters from now. Like it, and even the expectation that Wall Street has for earnings season coming up, like they're literally they're setting the bar very low. Well, not very low, but the bar is set pretty low in terms of the earnings season coming up. I really do think that a lot of companies are going to surprise the upside during earnings season next month?
For me, this LiDAR debate is probably going to come down to standardization, like Pedro was saying. If regulators end up saying, look, if you want to get level 4, level 5 autonomy, you're going to need LiDAR, then Tesla's going to have to acquiesce.
Oh, that'll be crazy. That stock will go to 200.
Yeah.
Low 200 at that point.
One of the things, I don't know if you saw this by any chance, but this is a company, it's called Aurora. They're building autonomous trucks, or they're basically doing the same thing Waymo is, where they take LiDAR and all the other sensors and cameras and they install them on trucks. So let me just share
I don't know why they don't do this at scale already. I feel like this is the easiest layup here to do something like this.
While there's a safety driver behind the wheel, these trucks are operating completely autonomously.
It's corny ass music, dude.
They belong to Aurora, a self-driving technology company hoping to launch with no one in the cab by next year.
Today, if you want to take strawberries from California to Dallas, it takes about 3 days. With the Aurora driver, you'll be able to do that in about 24 hours.
Self-driving trucks can see better, they can see further, they're not getting tired, they can operate 24/7.
That means that a truck that could normally do 450 or 500 miles a day could do 1,000 to 1,100 miles a day. That significantly increases the profitability of running that truck.
The introduction of autonomy in trucking could have a major impact on the industry.
Our economy runs on the trucking industry. As the industry says, if you bought it, a truck brought it.
It's a huge ecosystem with over $1 trillion of spend just in the US.
The pandemic highlighted the importance of supply chain, and demand has only continued to climb.
Goods movement probably doubled over the last 3 years, and the whole industry has been sort of racing to have enough capacity.
CNBC went behind the scenes with Aurora to see its self-driving operation in Texas.
We've driven right around about 500,000 miles pulling loads for customers. I think we're over 1,800 trailers delivered.
It has been a challenging road for self-driving trucks, with several startups throwing in the towel. The technology has taken far longer to realize than initially anticipated. And even as driverless cars hit the roads, it is yet to be seen how well they'll function in the wild.
Across the industry, many folks expect that it will take a couple of years before we'll even see point-to-point deliveries without the help of engineering talent.
I think it's tremendous opportunities for driver assist and improved safety, less driver fatigue, but I cannot see 80,000-pound trucks in my lifetime running up and down the road just as harmless, gentle giants.
You can get a ride in a self-driving vehicle in San Francisco. You can get one in Phoenix. We're on the road pulling loads for customers every day. This will be the next transformation in that space, and it's going to make it easier to get around. It's going to make it safer to get around.
How old is that video?
That's long.
Moving on that.
Right now,
how old is that video?
I think a few months. I have to look 6 months.
Oh, just pretty recent. Yeah, I went ahead and looked up the stock and looked at the chart. I want to say, so when are we buying spreads? Not just kidding around.
No. So the thing is, they've been testing this thing in Texas. So Texas is allowing the autonomous trucks on their highways in certain designated corridors. So, like I said, autonomous is here. No matter what people want to believe that, hey, we're always going to need this, that, and the other thing, autonomy is starting to make its wave. 5 years from now, I highly doubt that we won't have cars like Waymo and Teslas and Zooks around driving us around in major urban, especially in major urban corridors. Will it be there in the rest of the world? No, I think the proliferation of that is going to take a lot more time. But the point is, this is the next evolution. I mean, you have a Tesla, and I'm sure you do you have FSD or no?
Hell no.
No, right? But there are people who do have it and they use it.
No, I'm not paying for that, man. I'm good. I don't need to pay I don't need to pay $100 a month. I mean, there's other. Well, no, I'm not a fan. I'm not a fan of FSD. See, this is the whole thing. Like, this is the whole thing where I'm like being realistic here. Is that in its current state, I don't think it's perfectly capable of running full fledged without supervision, which is the reason why it's still supervised. But I think they're going to figure it out at some point. The day's just not today. Like, and I don't know why people expected it.
I can't wait for my mom to use a Waymo. Like, because right now, my brother lives not too far away from her, but basically anywhere she needs to go, she doesn't drive. So she would have to like order like a Uber or something, right? Like if this was the case, she'd feel a lot more comfortable. Go to Waymo or go to Uber or Tesla, whatever, and just order it. She can get in, go to Walgreens, and come back at a reasonable price.
Yeah, I mean, it is an exciting time to live in, because you just look at the world today. It's going to be a lot different in a few years, and people don't want to believe it. You don't have to believe it, but that's honestly where everything's headed. I feel like the whole political theater that's happening right now is literally like a diversion of just everything that's happened in the background. Just all these mega companies spending like almost $200 billion a year aggregated, or more than that probably, on just improving everything. And in my job, it's really come to the point where it's like, you guys need to be using AI like in everything you do. Like it's not even a choice. And it's happening everywhere, right? It's just that people haven't necessarily felt the heat yet, and it's coming. I mean, even Andrew Jassy has said, like, we're going to downsize a lot because of AI. You already saw Microsoft. They laid off whole departments and so on. Guys, it's coming. You better learn how to use this stuff. If you don't learn how to use this stuff, you're going to be set. Yeah, you're going to be very behind. And don't take it for granted, guys. Don't take it for granted.
You know what I'm learning right now? Replit. I'm trying to I was like, all right, let me start to figure out how to use Replit, because there's certain things that I want to do from like, what is that thing called? With stocks, that Replit helps you identify and create apps specifically for it. So I don't know how to use it, but I'm learning, because this could be something I could use for better investing.
I would say learn how to use Python, dude. Just take you don't even need to take a course. Just like use ChatGPT and just ask it to teach you Python, and it'll teach you Python. It is the most universal code you can write in, used across pretty much any operating
system. I'm too old to learn, bro. I'm too old to learn.
Dude, let me tell you something. It's so easy to build something with ChatGPT, like unbelievably easy. You can build something you would have never thought you'd be able to make in just minutes. Like, it is just crazy, the capability of all this software, especially in my field as a software engineer. Like, you have to know how to use it. If you don't know how to code in a couple of years, and you work in IT, like, good luck. Like, good luck. You're going to be replaced very quickly, unless you, like, of course, work in desktop support. But even then, it's like, I don't know, man, good luck. Like, I feel like in IT, if you don't know how to code in a couple of years, like, you better learn. And you can learn in like a week. You can literally learn in a week just by messing around ChatGPT. So yeah. With that being said, we didn't have time to go over hymns. Too long, didn't read. I am not adding the hymns right now. I don't plan to add the hymns right now. It is a 1.5% position in my portfolio. I do not plan to make that position bigger. I definitely don't plan to add leverage on that. I mean, we could just kind of 5 minutes. I'm gonna go over hymns. 5 minutes. So let's see.
You can go over that. I gotta head out, so I'll talk to you.
All right, later, dude.
Later.
Amazon is my biggest position. So let's see here. I want to share this tab. And thanks for sticking around, guys. We got 83 people here on YouTube. I don't even know how many people are on Twitter, because this thing never updates, but I'd imagine it's over 100 people on Twitter, which is great to see. But if you guys haven't already done it, go ahead. We have our own YouTube channel, a Hidden Edge Pod on YouTube. Go ahead and follow and subscribe to that one. And it's absolutely free. We don't charge people to subscribe to our YouTube channel. So go ahead and check that out. So anyways, I'm going to be talking about hymns right now for a minute. And look at that. What's up? Right there. All right. So hymns had a historical drop yesterday. 34% drop. Let me actually bring up the stock chart over here. All right, so this is your stock chart, and this is the historic drop that we have really never seen on HIMS pretty much ever. The stock was basically down 34% yesterday. And if you look at this chart, I don't even think it's even been up 34%. It was the most dramatic move you've seen. And it was really on the back of the news that Novo Nordisk is terminating their partnership with HIMS on selling their All-Star Wegovy weight loss drug and letting HIMS sell that through them. Novo Nordisk is actually it actually doesn't, it's not like a Eli Lilly that you guys would probably already hear about. They do compound their own weight loss product, Wegovy, which was sent through HIMS. And there was a lot of, we're gonna grow a lot, we're gonna partner, we're gonna sell these products. And you're saying that the thing is that there was a bit of speculation on Wall Street of how beneficial that selling Wegovy at a cheaper price too on HIMS would actually be very beneficial for both companies. And then Novo Nordisk turned around. They basically accused HIMS of doing all these crazy practices that isn't allowed by the FDA and all this stuff. Like they were making some crazy remarks on it. Now, with that being said, the reason why I said I wouldn't add to HIMS is not because like I don't think that, Novo Nordisk is right, or I don't think Andrew's right. Honestly, I think HIMS is going to figure out this whole situation. I think they're going to get past it in a couple of years. We're probably not going to be thinking about the situation, which is pretty much what happens every single time we hear some crazy news in HIMS, is that it basically recovers from that scenario maybe like a few months later. Like the stock chart is just up and down, up and down, up and down. It's a very volatile stock. So if you're down 34% in HIMS in one day, you just should not be surprised that something like that happens. Like we were literally at $28 less than a couple months ago. And then we are at 72. We are at almost $70 a few weeks ago. And then now we're back at $44. I would say that it wasn't even that bad of a drop, in my opinion, considering that we are not back in the $20 range, but it can happen. That's the reason why I'm not trying to add to it right now. My average is in the $20 range, and I don't plan to average up in my case. I'm very comfortable with my size in it. I don't plan to lever up. I think there's a lot of other opportunity in the market, because still, I would say that just looking at a chart, I would still say, even though from a fundamental perspective, HIMS at $44 is still somewhat a good value to buy a company. But at the same time, I don't think that it's in that I understand this company left and right from my perspective that I want to make it a bigger position than 1.5% of my portfolio. So it depends on really how comfortable you are with doing that. But the things that I pointed out after Andrew Dudum released his remarks it was actually released through a Bloomberg article, and I kind of like summarized it and gave my input here. But what basically happened is that the breakup looks like more of a strategic move, in my opinion, from Novo Nordisk to get out of their partnership with HIMS. So from that perspective, I think Novo Nordisk has an ulterior motive here to get out of this partnership. Maybe they want to sell on their own because they realize like, oh, we could actually make a lot of money off this and increase our margins if we sell this on our own versus selling this through HIMS. So maybe that's their motivation for doing this, and whatever it is. Like, business is business, guys. Like, I don't think Novo Nordisk really cares about whether HIMS is actually breaking any FD rules or not. I don't think they are. I think if they were, they would not be on this crazy run the last few years. And I could be wrong, but the reason why I wouldn't add to it is because there's inherent risk around the market, because there's a lot of uncertainty that hasn't been covered. Is the FDA going to crack down on HIMS? Is there a lawsuit that's going to open up? And if that does happen, the stock is probably going to go lower. So which in that case, if I were to buy now, I would be speculating that that's not going to happen. But I think it's going to happen. And even if it doesn't happen, I think the market is going to kind of sniff out any scenario where it might happen. So you just get like one headline saying that Novo Nordisk is opening up a lawsuit against HIMS, or the FDA is investigating HIMS. Dude, HIMS is going to $20. I don't want to put that risk on my portfolio in case that happens. I'm sure they'll figure it out. And I'm sure that they'll be back in $70 at some point. I don't know when that point is, but at the same time, I don't want to buy today with the risk that they might go to $20 again. If it gets $20, maybe I'll add to it. But until then, like, I don't want to buy here. I have an average much lower than this. I don't know this whole pharmaceutical industry left and right, like a lot of other people do. I'm sure I'll be completely honest. I'm sure there's a lot of people out there who know much more about the situation, could explain it to you a lot better. But from my input, I would not buy right now. But that's just me, right? So say that I'm a Hims bear, Hims bull, whatever you want. I personally would feel more comfortable adding to the position in the lower $20 range, which my original adjusted basis is actually in the teens, because I was playing the call options on it when it was sub $20. But at the same time, you know, from just a longer term shareholder perspective, I would not add to my position if, bro, what do you understand? Not what others tell you to. Okay, buy what you understand. No, that's true. Like I'm only buying what I understand completely. And that's the reason why Amazon is a much larger position than Hims, even at its cost basis size. And I would say the same thing for everyone else. Like, don't buy a position because it looked good in a chart from a long-term perspective. Buy it because you understand it, right? So if you feel comfortable buying a position and making it a big size, like there are a lot of people who were buying a lot of NVIDIA when it was at $80, $90 the other month, because what is there to not understand about NVIDIA? Like every single Wall Street analyst is covering this company, right? You can literally pull up an article and then read all about it and learn everything you want about NVIDIA that would make you bullish enough to buy NVIDIA at $90, where it's trading at a historical lower PE than it is today, and get in. Is Hims trading at a historical low PE or price to sales than it was a couple months ago? No, it's trading more expensive than that. In my opinion, the asymmetric trade is like, I don't know. I would say Hims fair value for me is like $50. Above $60 was when I was trimming. And now we're back to $40, and that's not a discount enough for me to get in. But I'm not an expert in this scenario. Maybe you are. Maybe you see this whole pharmaceutical secular trend much better than I do, and maybe you have much more conviction that it makes a lot more sense to add to the position here than it would for me. And that's your portfolio. You manage your money the way you want to, and I'll manage it the way that I want to. For me, I'm focused more on secular trends when it comes to software and when it comes to AI data center technology. This was I never meant for this thing to be 3%, which is where nearly double where it was from here. And that's why I was happy to trim from there. So that's really all I can provide you guys in Hims. I mean, you can check out what I wrote up, like the 2 paragraphs that I wrote up on in Twitter if you want to. But again, there's a lot of really good resources out there that really break this down in a much better manner than I did. But one thing you got to remember, though, is that last quarter was a really good quarter for Hims. They had a triple beat across the board, but that was based on the assumption that the partnership would be maintained. And now it's not. What would my draft picks be? I don't know, man. All in NVIDIA. I have no idea. Did I cover New? No, I actually did not cover Nubank. Didn't really have time to, and I'm probably going to sign off soon. But Nubank is looking pretty good, even from a technical perspective, where it's trading at today versus where it was trading at, I don't know, yesterday. So had a very big 8-9% day today, which was pretty crazy because there really wasn't a whole lot of news as far as what happened today. But I mean, you know, if you look at the chart here, came up from the April lows and basically having somewhat of a bull flag over here, or I would say a bullish pennant, kind of a triangle here. So if I do this, this, and then this, oops, let me get another line over here. This, that's a bullish pennant, which is a bullish setup. And then obviously we broke out of that today. So that chart's looking pretty bullish here. Still sitting probably, I would say like 25% below its all-time highs. And let me go over what had happened today in terms of why I think the stock was up today. Reddit also had a really good today. That's actually up a lot overnight. Oh, GitLab. I didn't really talk about this one. There's someone that like really thinks I'm insane for buying GitLab in the audience, but that's cool. I'll do me. But if you look at the previous videos on our YouTube channel, I talked about GitLab several times. I think this is probably one of the best values in the software sector right now when it comes to buying a company that's growing at 25%. In addition, it was actually named one of the beneficiaries from Bank of America. Considering though it pulled back pretty materially since its earnings, I think it was down like 20% from its earnings, and it actually made a low last Friday, I think around like low $40. So like bouncing back over here to like 42.5 really isn't a big bounce considering where it was trading before earnings. So I think it has a lot of room to run up now. Go ahead and check out the Patreon if you want to find out exactly what I have in that one. But over here in Nubank, so this is probably the reason why I had a big run up today. And it's not because the fact that it got picked as a top pick from any sell side firm, but the fact that it was from Morgan Stanley, which is a very, very reputable sell side analyst firm. They basically gave it a price. Well, not gave it a price target. They reiterated their $18 price target and said that it was their one of their top picks. And they expect that it could penetrate about 10% of the payroll loans by 2026 for Brazil, specifically Brazil. And a lot of you guys probably not following the central bank in Brazil. They're in a rate hike cycle. Brazil's inflation is a lot more stickier than it is in the US. However, in my opinion, I think the inflation is still in a downward trend, but it's just become a little bit sticky lately that they had to continue with their rate hike cycle up to, I think they're at 14.75%. I forget what the exact number is. And it seems pretty crazy, right? 14.75% interest rate, right? But this is Brazil. We're talking about a very strong, fast growing, I think like 4% plus GDP or 3 to 4% GDP, growing very quickly, consistently for the last 10 years, not like the last couple of years or anything. So like they can maintain higher rates and still continue to grow at 3% plus without a problem. Also, President Lulu, he is a very big like private sector guy. So he's all about business, kind of like Trump, but not exactly like kind of like Trump. And he did put in a new head of the central bank there, which is actually very much interested in the private sector as well. So you kind of have like that double tailwind there from not only from a fiscal perspective, but also a monetary perspective in terms of a central bank monetary policy on kind of giving a tailwind for that growth for the entire economy. And also, you know, like I said, Brazil is an emerging market, and Nubank is in Brazil. It's in Colombia. It's also in Mexico as well. Obviously been in Brazil way longer. I think they have about 60% of the adults are clients of Nubank. And that doesn't mean that 60% is not a client of any other bank. That just means that they are a client of Nubank. And I think there's a lot of room to grow there as well. In addition to Colombia and Mexico, where you're talking about pretty much unpenetrated, underbanked markets where there virtually is no competition growing at this scale in those regions. So very, very bullish for Nubank. I think that it was kind of ridiculous how it was still selling the low $10 range, considering that it's trading today after this run up, it's trading at a 21 PE. Nubank has historically traded at, 21 forward PE. Nubank has historically traded at a 30 trailing PE. So if you do project that forward a little bit by a year, Nubank should be trading around $18, which is where their price target is. So there's quite a bit of upside, about 25% of upside from here for this $18 price target range. But, you know, I think Nubank has basically been in consolidation on the chart for, man, how long has it been in this range for? Actually, now that I think about it. So if I go on the weekly chart here, yeah, I mean, this thing has been basically consolidating for over a year now. And I mean, these kind of charts, like especially looking at the weekly chart here, I mean, since 2022, so this is what I'm looking at here when I look at this chart. All right. So I see this big move up, right? And then I see this kind of bull flag forming here. Okay, so like I'm just being optimistic when I look at this chart. Obviously, I'm biased because I'm bullish Nubank. But when you're kind of in like this weird consolidation phase for some time, and then you finally have this test of a breakout here. So if I go to this candle right here, all right, and I do that, and then I'll make like a little range right here, right? So we can easily reject this and come back here and test down and probably break $10, right? But it's very tough to see that happening if the market stays bullish, which, you know, it could still happen. I'm not going to guarantee it can't happen, but honestly, this is a very rough range that I put here, a rough channel, but it looks like today considering even looking at the volume today, it wasn't that strong. Like I would have liked to see a day like today with volume like this, but it wasn't that much volume today. So Nubank is a very volatile stock. So I would not be surprised if this kind of gets rejected and pulls back a little bit. But considering how bullish the market is, and considering where the monetary stance is as far as Brazil goes, where they don't expect to cut for some time, that's quite a bullish backdrop when you think about loose monetary policy or monetary policy loosening in Brazil. And even from a technical perspective, if this breaks this line right here, you're going to have a lot of algorithms buying up this stock. And if we look at how far the stock is away from its all-time intraday high, we're at about 20%, right? And then Morgan Stanley's price target, doesn't mean it's going to reach that price target. It's about a 34% upside, right? So right now, I have a lot of shares of the company, and also I have leaps on the company too. So if it does go up, I'm probably going to either sell calls against it or, I don't think I'm going to sell my shares, to be honest, because like I want to hold on to this for long term. But I mean, if it does make moves like that, that would mean a new all-time high in Nubank, and that would mean a lot of chasing, in my opinion. So we'll see what happens with that one. That's obviously being very optimistic. But even if we look at the way the market is, just from like the consolidation it's basically been in for more than, I would say, a couple of weeks now. If I look over here at the NASDAQ chart, it had this big move up, and it basically has just been in a bull flag for a month, right? And we finally broke out of this channel right here. So if I draw this channel here, right, kind of put that channel there and then do this one right here. Let's just put in the bottom end, right? Or even if I want to consolidate a little bit, even for about a few weeks here, it finally broke out of it. Like this is like such a bullish setup. And the fact that it wasn't even that much volume, the fact that we broke out of it. So it has been a little bit cautious here, but obviously there's a lot of people looking at these charts around the entire world. People could be speculating this on a much greater, more expertise perspective. Like I'm not a TA expert. I just try to put all the tools in my tool belt and put it together to create my bullish narrative on a stock. Easily, I think we're going to go to all-time highs, which isn't that far away from here. SPY, I think, is about 1% away from all-time highs. So if I look at this over here, yeah, SPY is like about 1% away from all-time highs, which I think we're going to get there easily. It's actually really funny because yesterday morning, no one would have said we would hit all-time highs this week, and then here we are today, right? And even overnight, futures are they're not running that hard, but the VIX is at 17.5. If we do a quick look at the VIX chart over here, I mean, VIX has just been planted, just selling relentlessly below $20 every time it goes above it. So like VIX comes here, rides up above $20, gets sold off. VIX comes up here, $20, sell off, right? We haven't even gotten to like VIX in like the 12 or 14 area yet. If it gets to the 12 to 14 area, like it's just going to be like slow melt up grind most likely. And that's unless, of course, we get some crazy black swan event where like this happens from the tariff news, or where like this happens from the Japanese yen carry trade risk, or if like this happens from a rate tightening cycle, or if this happens from COVID. These don't happen too often, guys. These big spikes in VIX, this is a weekly chart. It doesn't happen too often that the VIX gets all the way up to 60. The last time it got to that level was, of course, the yen carry trade, COVID. Before that was 2008. Like we literally had VIX at 60. Like I don't know, even looking at the probability of this happening again, like it's not going to happen anytime soon. At least I don't think it is. Probability is on my side when it comes to that. And if that doesn't happen anytime soon, where does VIX always consolidate? In the low teens. Like the 17 to 12 level VIX consolidates. And we've been like VIX like around $12 for like almost all of 2024. And then pretty much almost all of like a whole decade below 20, right? Of course, you had these random spikes, Volmageddon, which is like crazy volatility event that happened in 2016. And then you had the the Powell pivot in 2018 and so on. Then you had the 2019. I think that was the trade deal situation that's happened with China. Like, we're getting out of that trade deal scenario. Like, this is probably one of the most bullish setups you could think of in a market, and people are still bearish. It's just so difficult for me to be bearish in this situation. And I've been cautious the last couple of weeks, but I have not been bearish since April. Like, I think it was like I stopped being bearish right around the time that Trump said that he was going to delay those tariffs. Like, he pivoted, right? That night, what was, I keep forgetting what day April 9 was. I think that was a Wednesday night. April 9, midnight of April 9. So like as soon as April 9 hit, he put on those tariffs. Like, not even 12 hours later, he delayed the tariffs. That's a pivot. That's a pivot. He is no longer about the crazy tariff situation. He's all about making the deals, right? And he's making those deals. Like, in my opinion, there will be deals across the board in every single country. I just don't know when, but it's going to happen. And I think the market sniffs that out too. And just like, well, he's going to make these deals at some point. So we're just going to continue making new all-time highs. It's all about perspective here. There's actually this video from Lizanne Saunders that I think she was on CNBC today that I wanted to play for you guys. Kind of like explains this in a really good way. Explains how the market is pretty much about expectation, right? So let me open this up here.
Schwab's chief investment strategist, Lizanne Saunders. It's good to see you.
You too.
We're not that far away from new highs, and you can thank the growth factor for getting us there, can't you?
Yeah, so that's been interesting. Momentum has certainly picked up as a factor doing well, and that's not surprising when you get these kind of rip higher rallies. But aside from that, which isn't really a fundamental factor, it's more like a concept. It just means that stocks that have been working continue to work. But it's interesting that also kind of up the ranking on the leaderboard are those more growth-oriented factors, both historical growth and prospective growth, so positive earnings revision. So it clearly tells you that there's still a bit of a quality bias in terms of what's working, with an emphasis a little bit less on valuation, but more on, can you sustain that earnings growth? Are you in a position, either because of immunity to tariffs or whatever the reason, that you've got that positive outlook from an earnings perspective and an otherwise murky earnings outlook more broadly?
What do you think this move is about today? Is it about the Middle East not going to be as bad as investors feared just a couple of days ago? Is it about Chair Powell being firm but flexible on what the Fed might do in the months ahead?
So I've been in this business, Scott, for almost 40 years. And one of my mantras that I express quite often is that better or worse often matters more than good or bad. It's relative to expectations. It's that direction of travel. It's inflection points. And we've really seen that come into play in the market going all the way back to early April, when we had the, week apart tariff shockers. April 2nd, the announcement of the reciprocal tariffs, the implosion in the market, and then the delay. Still looking at a 15% average effective tariff rate in place right now, but it was that better than worst case scenario in that first week in April that kicked in. Same thing has happened as it relates to the conflict in the Middle East. Concerns that obviously developed over the weekend, and the spike we saw in oil prices, and what the futures were signaling on Sunday night, when things were not as bad as what was expected. We weren't seeing an escalation. That was enough to move the market higher. And I still think the pain trade is higher. So we have to really think about not just trying to gauge the news and the announcements from a policy perspective, geopolitics, tariffs, but also what the setup is for the market as to whether that means you have more potential upside if you get that slightly better news, or maybe the risk of some downside if you get a negative catalyst. That setup is really important.
I still feel like not everybody is participating in all of this from an institutional standpoint. Right. And that's a catalyst in and of itself, when the writing gets on the wall that we're not only going to hit new highs, but we have the possibility of going even higher than that. There goes your next leg of this rally, if there is to be one.
And this has been such a fascinating move up off the lows in early April, because retail traders' fingerprints are all over this. And notice I said retail traders and not individual investors. I'm specifically talking about that category that kind of came out of the COVID era. The shorter term focus, they have very much a buy the dip mentality. And you saw and have seen those fingerprints because it's areas like retail favorites and negative earnings in the tech space that has done well, the meme stocks that have done well. And then more recently in the rally, you saw the heavily shorted names perform well. And that may suggest that buy the dip, which worked on the part of the retail traders, forced some rethinking of positioning on the part of institutions. So you saw it in the short covering. Institutions are still not positioned aggressively risk on, which does suggest that maybe the pain trade is still higher from an institutional positioning perspective. But when we get there, and assuming you still have, rampant enthusiasm on the part of the retail trader, then the setup becomes one that maybe is subject to some downside if you get a negative catalyst.
Yeah. So
Brian Belski, your take on things.
She explains it pretty well. No, we're not going to go all night, dude. Yeah, I'm still live, dude. What's going on? Oh, Tyler, yo, what's going on from Thailand? How you doing? What do I think about Oscar Health? So actually, Kris did a pretty good live DD on Oscar Health the other week. If you go to the YouTube channel, go there. You can just check out the last live stream we had with Kris and I, and he went over Oscar when it was like $15. So still considerable upside from there after he got in, but a little bit of a pullback now, and I don't think anything's actually changed in the last in last week. So I'm sure all that still stands, and that's free and available for you online. Do I keep any dry powder? I have very small cash position aside, like 1 or 2%, and I'm probably gonna just allocate that at some point this week. I don't have a lot of cash, to be honest. I add to my portfolio very consistently. Every couple of weeks, I add about 1 to 2% of my portfolio every month, aggregated. So every 1 to 2 weeks, maybe I add 1% here and there. So I add the portfolio pretty aggressively. And the reason why I'm comfortable doing that is because I already have an emergency fund set aside, money in the savings account. So I'm allowed to take these risks to meet my financial goals when I retire. So, it really is different for everyone from that perspective. I think people who have like a large amount of cash very suddenly, I don't want to speak for them, but 10% lower in that SP 500. I was seeing a lot of people have like, I have like 25% cash. I was like, well, okay, but now we're 10% higher. Now you're slowly deploying that cash that, you said you'd keep. Who knows? We'll see. I mean, we could all be wrong. Warren Buffett could be right, and we could all be dead wrong. And we could have the worst financial collapse we've had in 30 years, right? So, or 20 years. So we'll see what happens with that. Other than that, game on. So how many positions do you have? Let me ask. I actually have a Savvy Trader account. It's on the link of my Twitter account. And my daughter's actually awake, so I'm gonna have to actually go soon. So yeah, I think I have too many right now. I think I have like 25 positions, and I'm like every day. I'm like actively just researching the companies that I have invested in. And I'm trying to just pick some companies off, and I'm just trying to concentrate the portfolio right now. And what I'm factoring into that is really a lot of the performance as well. And if the current fundamentals that are with my stocks that I own will meet that catch up that I expect. So a good example was actually Reddit. I was buying Reddit pretty hard below $110 and adding pretty considerably to it. I think that's like I think I added to that position recently because I sold my position in TTD, but I added to that and Apple Oven as well because I just want to kind of consolidate my ad tech bucket. And plus, I had sold Google at like 157, and I bought Meta at I added double my Meta position at like 627. So. Just mostly because that's just where I saw my vision was. I understood Meta a lot more than I could from Google, especially if I extrapolate that maybe years in advance. I could see a lot of potential for Meta to possibly outperform Google. But, everyone's opinion is different in that one, and that's mine. And I'm happy with that decision that I made. But the next companies I'm probably trying to take off of my portfolio, well, to be honest, Hims is kind of on the chopping block with me. I mean, we'll see what happens. If there's like more concrete news that Hims is like seriously getting investigated by the FDA, I don't mind cutting that one at a loss. Don't mind cutting that one at a loss at all and just putting that to something else. But, again, that's it really just depends on where your conviction is. And for me, Hims isn't even a big position. So it's a lot. It's a lot of news to digest for a small position. And I only have a finite amount of time in my life, right? Like I have kids and everything. Like I don't have a lot of time on my hands where I could be, researching these stocks all day. I can't. I got to be realistic with it. So I need to be realistic about my mental capital. So that's important. Yeah, no, I have Hood. Hood has done pretty well lately. And going to continue just enjoying that one. I think as long as the market stays bullish, I think a Hood is going to continue to stay bullish. So valuation get a little excessive, but so is the stock market too. One thing I wanted to kind of go over here is one of the reasons why I think that we have a pretty good setup coming into the earnings season for Q2. So this is from Yardeni Charts, and he has the estimates for the Q2 2025 earnings. And I believe that's what we just had, right? I think that's what we're coming up to, Q2 2025. Yeah, July, and that'll be Q2, right? So analysts, this column over here is where analysts or consensus sees estimates for the earnings to come up on. So they expect earnings growth to be 3.8% for Q2 of 2025. And they expect earnings to be about $62.07. And this is across the entire market. So really the one you got to worry about is the growth here. We went from near double-digit growth, 13.7% growth on earnings for Q4 of 2025 to high single digit for all of 2025. And then actually, no, this is the expectation. Hold on. Let me just think here for the second. Okay, no, sorry. This is the earnings growth for all of 2025. So Q4 was 13.7% earnings growth and Q1 was 11.7. And analysts really revised down their expectation for the earnings coming up, the quarter that is just going to be reported, to 3.8%. And Yardeni expects it to be 7.6%. That's double what the expectation is. And I just played for you the clip of Lizanne Saunders talking CNBC. The market basically moves off expectation. It doesn't move off of absolute values, right? It moves off of what is expected in the future. And if you beat that expectation, the stock usually gets re-rated higher. If you miss that expectation, you usually gets re-rated lower. But depending on the valuation, you have to kind of beat, especially if you're trading at a very expensive valuation. So in this case, the S&P 500, we're back to all-time highs. I would say the valuation of the S&P 500 has been quite extended for some time. So, anything can really bring the market down. It's kind of sensitive up here. But at the same time, the expectation is a 3.8% growth earnings yield for this quarter. That is setting the bar pretty low, considering that it's not just Yardeni, but if you look at all the estimates companies give, especially coming out of April, which is a very slow month for a lot of companies across the board, even leading into April, a lot of companies are very conservative about their estimates or their guidance. And even a lot of companies, including FedEx today, didn't even give guidance, right? So the expectation is very low, 3.8%. If we come 1% above that, look at these estimates from before versus meeting Yardeni's. Actually, no, these are actual, so they're going to match. But we've beat expectation for quite some time. If we beat these expectations for this earnings season, we are ready for another leg up. And I don't mean to sound bullish. This is literally based off expectation. If the bar is set low, it's a great setup for the next leg, in my opinion. I don't have that big of a cash position because, one, I'm adding to my account every other week, so I could always just add cash to it. But two, there's still a lot of bears out there. There's still a lot of people thinking out there we're going to have a recession or under-allocated hedge funds and so on. Maybe not as under-allocated as you were about a month ago, but I don't want to say like, oh, all the money in the money markets is money on the sidelines. Like, that's not the case, guys. Like that money is going to stay in the money market funds likely for a long time, and it's not really going to make a big dent. But when you think about money on the sidelines as in allocated institutions, there's still a lot of institutions out there that are very skeptical on the market. We had massive downgrades in the S&P 500 end of year targets across the board in April, leading into April, and even keeping those targets still to this day, with some that maybe increasing a little bit, but those targets are still below where we are today. They have to revise those targets upward. And there's a lot of money that looks at those targets and makes investment decisions based upon the risk and reward from those targets that these institutions are given from these analyst firms. And if they re-rate those targets higher, then they will buy more because it's a higher risk reward. We have not seen that happen yet. We saw every single analyst across the board make like S&P 5,000, 6,500, S&P 500 at 6,500 or 7,000 plus by the end of 2025. Everything got downgraded down to like 6,000 by April. And then now they got to increase it again. The next leg higher. It's all about expectations. The bar set low, probably going to beat that. Market's probably going to be higher by the time the end of the earnings season in July. With that being said, look at the earnings estimates for Q3, which is the earnings season in late September, October, 6.4% higher, right? So they're expecting a higher yield in the next quarter after that. Yardeni's expecting minus 1.9. I think that same seasonality. I think we're probably going to get a pullback after July, or maybe a sideways action, and then probably recover in the fall. This seasonality, I think seasonality is going to take into effect what we just saw before, but I could be wrong. That's fine. But if I'm going to start creating a cash position, it's probably to be in July, maybe around the earnings season, if things start to get pretty heated at that point. So with that being said, that's basically all I got to say today. Late pod, but this is of course available for all you guys after as a full recording. Again, thanks for watching, guys. Go ahead to our YouTube channel, subscribe, Hidden Edge Pod on YouTube. Check that out. Follow me on Twitter. My Twitter handle is SamSolid57. If you guys are already watching on Twitter, you already probably are subscribed to me. If not, I would love to have you guys on board. Thanks for coming, guys. Appreciate you all. Take care.